As many of you know, the bank is in the midst of reviewing its monetary policy framework, which will be renewed next year. This process involves asking some really critical questions, including how we measure inflation in an economy reshaped by powerful structural forces. The answers will guide the bank's decision in pursuit of its core mandate, ensuring price stability, which remains the foundation for sustainable growth and future prosperity. Now, before we dive in, let us take a moment to recognize the lands on which we are gathered. At Ivy, we acknowledge that we are located on the traditional lands of Anishinabek, Haudenosaunee, Lenape, and Adarandaren peoples. We also acknowledge that the Bank of Canada's head office in Ottawa is situated on the unceded territory of the Algonquin Anishinaabe people. By grounding ourselves in this recognition, we affirm our shared responsibilities, past, present, and future, as we reflect on the stewardship of Canada's economy in an uncertain time. Now, the tailwinds of globalization and relative global stability are giving way to new unpredictable shifts, from tariffs and supply chain rewiring to demographic pressures and disruptive technologies. These changes are bringing more frequent and larger shocks in the economy. In this context, accurately measuring core inflation, distinguishing temporary fluctuations from underlying persistent trend, has become more critical than ever. Inflation, yes, touches everyone, even our students. Okay? For consumers, it raises the price of essentials like food, fuel, and housing, eroding purchasing power and complicating housing budgeting. For businesses, it increases input costs, squeezes margins, and clouds investment and hiring decisions. For savers, when prices outpace returns on deposits or fixed income assets, the real value of savings declines, making it harder to build wealth and plan for the future. While deglobalization tends to be inflationary, we cannot rule out also potential deflationary shocks, potentially created, for example, by bursting of asset bubbles. Deflation discourages spending, deepens downturn, and makes debt more burdensome. So inflation is almost like in a blood sugar level, right? Too high is a problem, too low is a problem. And in Canada, the healthy range for inflation is between, as you may know, 1% and 3%, with the bank targeting the 2% midpoint. As challenging as it is to tease out inflation from the noise of all these shocks, it is essential that we do so. Understanding the true trend allows us to take the right policy steps to support investment, growth, and the prosperity for Canadians, especially in the circumstances our country faces today. Now, 2025 has emerged as a year of perhaps existential awareness. The United States, once a pillar of stability, is now a source of global uncertainty. With geopolitical and economic shifts reverberating worldwide, the tariff war has evolved to be more structural, underscoring a hard truth. Canada can no longer assume stability in its most important partnership. We must negotiate firmly with our southern neighbor and also take bold steps to expand our own national capacity. This is not just prudent strategy, it is an existential response to an existential threat. And to create the conditions for growth and investment, an important precondition is to keep inflation within target. It is against this backdrop that the work of Deputy Governor Rhys Mendes and his colleagues are so critical for the future of our country. And so with much anticipation and interest, we like to hear from him. A specialist in monetary policy frameworks and international economic policy, Rhys holds a BA from York University and an MA and PhD in economics from the University of Toronto. While Steve and Tiff could not escape Western, Rhys certainly did. But we won't hold that against him. And what a distinguished career he's had. Rhys joined the bank in 2004 and has held senior leadership roles in Canadian economic analysis, economic and financial research, and international economic analysis. He also served as Assistant Deputy Minister at the Department of Finance between 2021 and 2023. Subsequently, he was appointed Deputy Governor of the Bank of Canada. Rhys oversees the bank's economic and financial research, its analysis of international developments, and serves as the bank's G7 and G20 deputy. He has written extensively on monetary and broader economic policy, from inflation targeting to terms of trade models, the natural rate of interest, and even helicopter money. Okay? As a member of the Governing Council, Rhys shares responsibility for decisions on monetary policy, financial system stability, and the strategic direction of the bank. Please join me in welcoming Deputy Governor Rhys Mendes. DG, the floor is yours.
Thanks very much. Very kind.
Of course. We're good.
Thank you, everyone. Here we go. Now is it on? All right, there we go. Well, thank you again, Ramel. If people didn't hear, I want to just again thank you for the very kind introduction. It's great to be here in London at the Lawrence Centre at the Ivey Business School. It's great to have the opportunity to meet with all of the faculty and students here. I think in our increasingly complex world, it's more important than ever that we bridge the gap between the C-suite boardroom and the work that the Bank of Canada does. And with that in mind, I'm going to talk about a concept that I think is useful in many domains, in particular in both business and economics, separating the signal from the noise. So let me put it in business terms first. Imagine you're listening to a company's earnings call, for instance. You need to be able to separate the noise, the CEO talking about optimizing impact or leveraging synergies, from the signal, say a sustained decline in revenues. Central bankers do exactly this with inflation. We need to strip out the noise so that monetary policy can respond to the signal. Today, I'm going to explain how and why we do this. But first, let's go over some basics. So as Ramel said, Canada has a 2% target for total consumer price inflation. This target helps households, businesses, and financial markets know what to expect with prices. Our job at the bank is to keep inflation close to that target. We do this by adjusting our policy interest rate. But interest rate changes work with lags. That means we cannot and should not try to react to every wiggle in the monthly inflation data. To achieve our 2% target, we have to cut through the noise and identify the part of inflation that is lasting. The lasting or persistent part of inflation is what we call underlying inflation. It's our signal. My speech today is all about how we assess underlying inflation. One of the ways we do so is by looking at measures of core inflation. But I want to be clear that core inflation is not the only indicator we use. We've always taken a broader approach. Today, I'll begin by explaining what core inflation is and why central banks look at it. I'll introduce you to some of the measures of core inflation we use at the bank. Then I'll go over how we use core inflation and other indicators to cut through the noise and see the signal. And I'll explain how doing this helps us achieve our 2% target for overall inflation. Enfin, je vais vous parler du renouvellement à venir du régime de ciblage de l'inflation. Tous les 5 ans, on examine et renouvelle notre cadre de politique monétaire avec le gouvernement fédéral. Le prochain renouvellement sera en 2026. Pour le préparer, on prend notamment en considération cette fois-ci notre façon d'évaluer l'inflation sous-jacente, c'est-à-dire comment on utilise les mesures de l'inflation fondamentale dans nos analyses et nos communications. C'est particulièrement important dans un monde plus sujet aux chocs importants comme le conflit commercial. As I just said in French, I'll wrap up my speech today with a few words about the review and renewal of our inflation targeting framework. With that, let's begin. So I do a lot of outreach with Canadians as part of my job. And people often ask me, does the bank target total inflation or does it target core inflation? And if we target core inflation, does that mean that we ignore the costs that people face every day, like prices for food and gasoline and rent? So let me answer this right now. Our target is overall inflation, not core inflation. And so it might be helpful at this stage to clarify some terminology. Underlying inflation and core inflation are two commonly used and commonly confused terms. They're related but distinct. Let me start with underlying inflation. So underlying inflation is a concept, not a statistical measure. It tries to capture the persistent part of inflation that is related to economic fundamentals. These fundamentals can include things like imbalances between overall supply and demand in the economy or sustained cost pressures. We care about underlying inflation because we don't want to react to noise. And let me explain why. It can take up to 2 years for changes in the policy rate to have their full effect on inflation. So reacting to temporary movements could end up causing more volatility. Because underlying inflation can't be observed directly, we have to use other indicators to assess it. Measures of core inflation are one way we do this. So now let me clarify what core inflation is. Put simply, measures of core inflation take total inflation and try to filter out the short-term noise to capture the more stable underlying trend. They typically do this by removing volatile price changes. For example, one common way of measuring core inflation is to exclude food and energy, because price changes in those categories are often short-lived. Ideally, a measure of core inflation should be less volatile than total inflation, while still tracking total inflation's movements over the long term. This means that if you were to look at both measures on a chart, the core inflation line would usually be smoother than the line for total inflation. So I think we're getting a chart coming up. And when the chart comes up, you'll be able to see the swings in the gray range are smaller than the blue line. So it's smoother because measures of core inflation tend to reflect the factors that affect inflation over time, rather than isolated shocks. At the bank, we've been targeting inflation for more than 3 decades. And over that time, we've used several different measures of core inflation. What this experience has taught us is that there's no single perfect measure of core inflation. Every measure, however well designed, will at times send misleading signals. From 1991 to 2016, our primary gauges for core inflation simply excluded a fixed set of volatile components. Then in 2016, we embraced a more dynamic and flexible approach, adopting 3 preferred measures. The first is CPI trim. It trims out the top 20% and bottom 20% of price changes each month. The second is CPI median. It lines up all the monthly price changes from the lowest to the highest and then picks the one in the middle. The third is CPI common. It aims to track price changes that are common across categories. These measures served us well in the pre-pandemic period. However, as inflation surged after the pandemic, CPI common became difficult to use in real time due to unusually large historical revisions. That's why we stopped using it in 2022. And while our remaining 2 preferred measures have generally been helpful, they were less reliable during some periods. This is yet another reminder that when assessing underlying inflation, we must look at a broad range of different types of indicators. So before I get into how we assess underlying inflation, I'm going to take you back to the importance of separating the signal from the noise. Imagine that you're now leading the rollout of a new app. Some users are raving about the app's interface, some are complaining that the app crashes when syncing, and a few others are making jokes or posting sarcastic memes. The jokes and memes are the noise in this example, while both the positive feedback and the complaints are signals. Now, when you go to make updates to the app, would you tailor your response to just one complaint? It seems more likely that you'd look at many different reviews and try to build a picture of how the app is performing and what needs to be done to improve it. This is how we look at assessing underlying inflation. Our preferred measures of core inflation are an important input to this process, but they're only one input. Just like with the app, we can't base our entire assessment on one piece of feedback. So let's lift the veil a bit on our process. The starting point is, of course, total inflation. In August, total CPI inflation was 1.9%. At a glance, that seems pretty good, almost right on our 2% target. But our preferred measures of core inflation were giving us a very different signal. They were around 3%. One important reason for this difference was the removal of the consumer carbon tax. Excluding taxes, inflation was 2.4% in August. If we look more closely at core inflation, we see that all the measures we monitor rose at the start of 2025. In August, our preferred measures of core inflation were around 3%, but alternative measures were around 2.5%. So while our core measures were all telling us that underlying inflation had risen, they were giving us mixed signals on its actual level. Beyond core inflation, measures that track the breadth of inflation, or how widespread inflationary pressures are, were consistent with inflation at around 2.5%. So let me show you what this looks like. The top panel of this chart shows you the distribution of inflation rates across the CPI basket in the pre-pandemic period. It looks like a perfect mountain because these rates are spread out evenly around the 2% target. Looking at the bottom panel, you can see the mountain is currently tipping to the right, meaning the distribution is tilted modestly to the upside. Similarly, the share of CPI components growing faster than 3% is now above its historical average, as you can see in my next chart. And the share of CPI components rising by less than 1% has dipped just below 1, just below its historical average. And this chart shows you how the breadth of inflation relates to total inflation. The yellow dot is the reading for August. Historically, this level would have been consistent with total inflation of about 2.5%. So on balance, the evidence pointed to underlying inflationary pressures above the 1.9% level of total inflation, but below the 3% level suggested by the bank's preferred core measures. Most indicators pointed to underlying inflation in the vicinity of 2.5%. So I want to emphasize a couple of points about this assessment. First, it's meant to provide a rough sense of where we believe underlying inflation stands. It's not intended to be taken as a precise estimate. And second, recalling that underlying inflation is a concept rather than a measure, we don't always put a number on it. Often our assessment of underlying inflation leads us to conclude that it's largely consistent with the signal coming from our preferred measures of core inflation. When this is the case, we don't need to be explicit about underlying inflation. But this was not the case at the time of our July and September decisions. Underlying inflation was roughly 0.5 percentage point lower than our preferred measures. That difference might not seem like much, but in the realm of monetary policy, it is important. 0.5 percentage point can mean the difference between a hold or a cut. This brings me to another important point. When we assess underlying inflation, we don't just need to know its level, we also need to know what factors are behind it and how persistent those factors are likely to be. To figure that out, we look at the details of the components within the CPI basket. Two broad categories have stood out in recent months as being responsible for much of the upward pressure on inflation. The first is inflation in shelter services, which continues to trend down, but is still well above its pre-pandemic average. The second is inflation in prices for goods other than energy, which has risen and is now above its pre-pandemic average. But when we looked ahead, we saw reasons to believe that underlying inflation would ease. For example, rental markets are softening, which should help keep inflation in shelter services on a downward trend. And growth in input costs has largely normalized, which should help cool inflation in non-energy goods. As you can see, a lot more than just our preferred core measures goes into our assessment of underlying inflation. So I've defined underlying inflation, and I've explained how it differs from core inflation. I've also gone over some of the indicators we look at when assessing underlying inflation. So now let's talk about the future and the renewal of our monetary policy framework. Every 5 years, we review and renew our monetary policy framework. These regular reviews are a strength of our system. They give us the opportunity to assess the framework's performance, to reflect on what is working well, and to consider whether our current approach remains the best one for the future. As I said at the start of my speech, How we assess underlying inflation, including how we use measures of core inflation, is one of the themes we're looking at ahead of our 2026 renewal. Separating the signal from the noise is never an easy thing to do when it comes to inflation, but in the current environment, it's more important than ever. The structural tailwinds of peace, globalization, and favorable demographics are turning into headwinds, and the world looks increasingly prone to shocks. More frequent supply shocks could mean more variability in inflation. So we need to think about how we assess and talk about underlying inflation as we confront this new reality. Now, before I dive into this, I want to be clear that this review is still underway, so I won't have any definitive answers, but I can share some of the questions we're exploring on this theme, along with some of our findings so far. So I'll break this down into 3 parts. First, I'll talk about how we're re-examining some aspects of our current core measures. Second, I'll discuss some new measures and methods that we're exploring as part of our broader assessment of underlying inflation. And third, I'll explain some of the work we're doing around how we talk about underlying inflation. So I hope I've established by now that measures of core inflation are not the whole story, but they are an important element. With this in mind, we're asking ourselves if there are any ways we could improve our existing measures of core inflation. Now, some of you have probably heard of one of the trickiest components of the CPI, mortgage interest costs. When we increase interest rates, we want inflation to come down. But when interest rates go up, inflation in mortgage interest costs also goes up automatically. And because many Canadians have fixed terms on their mortgages, renewal at new rates happens only gradually, so the effect on inflation can be persistent. This poses a challenge because movements in mortgage interest costs can obscure the broader response of inflation to changes in our policy rate. It can be a source of noise. Some of our core measures automatically exclude inflation in mortgage interest costs, while others have been designed to filter it out when its movements become extreme. And while this is a good idea in theory, it hasn't always worked out in practice. So let me give you an example. After we started raising the policy interest rate in 2022, CPI trim correctly began to filter out mortgage interest costs. But since it's a relatively large component, its persistent exclusion limited CPI trim's ability to exclude other, more temporary sources of upward pressure on inflation. Because of this, the CPI trim measure of core was 2.5% in December 2024, while an alternative version that pre-excluded mortgage interest costs was 2.1%. The alternative measure was far closer to where we thought underlying inflation was at the time. So one question we're asking ourselves is whether we should revise all our core measures to pre-exclude mortgage interest costs. It's something we're considering carefully, particularly as we think about how monetary policy and imbalances in the housing market interact with one another. So improvements to our existing measures are just the first part of our work. The second part is exploring new measures of core inflation. These would not necessarily be replacements for existing core measures, but rather enhancements. And we need to treat each potential new core measure like an MBA case study, asking ourselves whether there's enough of a business case to include it in our already broad suite of indicators. One measure that has gained attention in recent years is multivariate core trend inflation. This measure isolates the persistent part of inflation. And then it decomposes that persistent part into 2 categories: inflationary pressures that are common across prices in the economy, and those that only affect prices in specific sectors. The initial results look promising. Another idea that we're exploring is whether artificial intelligence, specifically a clustering algorithm technique, can help us measure core inflation. And again, early results are good, but we're assessing the robustness of this approach. And this brings me to the third area of work, how we talk about underlying inflation and measures of core inflation. So we've long labeled one or more measures of core inflation as our preferred measure. And we've said these preferred measures are an operational guide to help the bank achieve its inflation target. At times, this language may have led markets to place more emphasis on the preferred measures of core than we do. In practice, our preferred measures are just some of the many indicators we use to achieve our inflation target. So this raises questions. Should we broaden our list of preferred measures, or perhaps even end the practice of identifying some as preferred? There are no easy answers here. While all core measures sometimes give misleading signals, our preferred measures have generally proven to be helpful. And more often than not, they've provided us with a clear way to talk about underlying inflation. But we also don't want Canadians or financial markets to become overly focused on a single indicator. Regardless of where we ultimately land, we can do more to make clear what indicators we look at. So to this end, we're planning to start publishing an interactive dashboard next year to house our broad array of inflation indicators. While we already do this to some degree, our new inflation dashboard will include more measures and be easier to use. So it's time for me to wrap up. So it's our job at the Bank of Canada to ensure that your money retains its value. We do that by keeping inflation close to 2%. We just went through a period where inflation was much higher than 2%. That was painful for all Canadians. Our 2% inflation target served as an anchor that helped us restore price stability. So while we are reviewing some aspects related to our inflation targeting framework, one thing we're not reviewing this time around is the 2% target itself. Comme je viens de dire en anglais, c'est notre travail à la Banque du Canada de veiller à ce que votre argent conserve sa valeur. On y parvient en maintenant l'inflation près de 2%. On vient de traverser une période où l'inflation était bien plus élevée que ça. Cela a créé des difficultés pour tout le monde. En servant de point d'ancrage, notre cible d'inflation de 2% nous a aidé à rétablir la stabilité des prix. C'est pourquoi, alors qu'on réexamine certains aspects liés à notre régime de ciblage de l'inflation, un élément sur lequel on ne revient pas cette fois-ci est la cible de 2%. The world is changing around us. The abrupt swings in U.S. trade policy have shocked Canada's economy, and we're facing structural change and rising geopolitical conflict. With these shifts come the potential for more and larger shocks. That means greater volatility in prices and the possibility of higher inflationary pressures. In this environment, cutting through the noise is more important than ever. As I said earlier, research and consultations for our 2026 renewal are ongoing. When faced with more uncertainty, we need to make sure we have the right tools to understand the factors affecting inflation. And we need to make sure we are being clear when we explain how we use those tools. With that, thank you for your time, and I'm happy to answer your questions.
Terrific.
Thanks.
Well, how about that, huh? It's such a lively talk.
I've never heard someone describe underlying inflation as lively before.
It is lively for economists that are paying attention to it, right? But it's packed full of insights, and you covered quite a lot in 22 minutes, for sure. And the idea of underlying, inflation as being a new concept that comes into your framework. I'm wondering, from the perspective more globally. We see different measures. The Fed uses the PCE, core PCE for that matter, right? Yeah. Are we moving more towards looking at different sets of measures here, or we're going to still? Of course, we've got the CPI trim, the median and common, right? And what are some of the benefits of looking at more broadly using that concept? The underlying inflation, if you will, given that we're in a volatile world here.
Yeah, so you're right. Internationally, practice varies quite a bit. So probably the most common thing to look at is some measure of inflation excluding food and energy. And in the 90s, that was the main core measure that we used. We moved away from that in 2001 because we had found that oftentimes there were temporary movements in other volatile components other than food and energy that caused the core measure to be misleading. So we moved to a measure that excluded 8 of the most volatile components. But then we found that measure was sometimes subject to movements in things that were not excluded that caused it to be misleading. And that led us ultimately in 2016 to adopt these more statistical dynamic sort of measures that sort of automatically exclude different things in different months, depending on what the most volatile components are in any given month. And so that has worked out reasonably well. I think there's always a bit of a trade-off, right? Like we moved initially to having 3 preferred measures. We now have 2. The more things we put in front of people, it can be confusing for people. But on the other hand, the reality of how we think about this is complex. That there's a lot that goes into our assessment of where underlying inflation sits. And so, I don't know where we'll land in terms of, exactly whether there are any changes made to the way we measure core, the set of preferred measures. But I think, as I said a moment ago, we want to start publishing this dashboard of indicators next year, because we think it's important to be transparent about what we're looking at. Right? Not everyone is going to want to go look at that dashboard, right. But for the people who do, that just provides a greater degree of transparency about what we're actually looking at when we assess underlying inflation.
And that connects with perhaps even the idea of forward guidance, right? If we were to think about, if we talk about the process and where that might be going, and if there's a better understanding, maybe weave that into how you're thinking about a better measurement, and perhaps the process could help, anchor that to provide, important forward guidance, if you will.
I think we're thinking about these things separately. So, we really see the core measures and the other indicators that we use for assessing underlying inflation as about assessing the current level of underlying inflation. And, that's where we see their value, and sort of helping us to get a better picture of what's going on right now under the hood in terms of inflation. So we aren't really making a link between that and sort of the forward guidance or the policy path.
I know there's a lot of questions, concerns around trade and how that is the tariffs are working out. Higher tariffs weakens growth and put down pressure on inflation. Higher tariffs also add costs and increase consumer prices.
Yeah.
Of course, the best way is to avoid all that is to have no tariffs, but unfortunately we're not in that world. So how are you thinking about this new concept and the data that you're putting together and looking at it in a different lens, if you will, that would help in particularly better capture the tariff-driven price increases, and maybe perhaps in thinking about expectations as well, in terms of that these costs are one-time effect and doesn't feed into the inflationary expectations, if you will.
Yeah. So there's a lot in there. So that on the tariffs and expectations, let me start there. So in principle, as you said, an increase in tariffs should cause an increase in the price level, but it should only increase inflation during that period of adjustment in prices. And once prices reach their new higher level, inflation should return to normal. Now, the risk is always that while that adjustment is playing out, people and businesses start to expect inflation to remain high, then that starts to affect their behavior and it becomes self-reinforcing, and inflation is persistently high. And that's what we want to guard against. That is a very important thing we want to guard against. And the best way for us to guard against that is to ensure that people understand that we're prepared to act in the event that we saw that happening. And I think, when I look at the post-pandemic surge in inflation, I take some comfort from the fact that, inflation got above 8%, but long-term inflation expectations in Canada stayed anchored. And so people believed that the Bank of Canada was going to do what it needed to do to get inflation back down to target. And so, that gives me some comfort that that in this situation, people would continue to have that confidence, but we can't take that for granted. We closely monitor inflation expectations, and we try to do stuff like this, where we talk about how we think about things to make sure people understand the 2% target, our commitment to the 2% target, and what that means for them. More broadly, there's the tariffs, and then there's the uncertainty that comes with the tariffs. And if you look at the way we do our jobs, we usually produce a forecast once a quarter. We produce a forecast for the Canadian economy and inflation. Normally, we would have produced that forecast in April and July of this year. Instead, we produce scenarios in those, so give people a sense of the different ways the economy could play out going ahead. We produced multiple scenarios in each of those monetary policy reports. The reason is just that the uncertainty around tariffs was so great that any forecast would have been so conditional on the assumptions we made about the evolution of tariffs that we didn't feel like we could really, at that stage, provide a forecast. Things were changing day to day. Now, things have sort of settled into a somewhat more concrete state since then. So we do plan to provide a forecast in our October monetary policy report. But what I would say is that it's still, we still do face uncertainty. Both, if we maybe face a little less uncertainty about the near-term evolution of tariffs, there's uncertainty on the horizon, things like, the review of CUSMA. And that's affecting us and how we do things. We're having to think carefully about how we take account of that. It's also affecting businesses and the decisions they make, and households. But
scenario planning is coming in and looking at different scenarios, perhaps, and then to think about where that we might land.
And that's where we were. So, but both in as I said, in April and July, that's where we were. We were in a totally scenario planning world. And so those scenarios are something we need to keep in mind. But now I think we will be able to provide a sort of base case forecast again in October. In terms of the core measures, the core measures are designed to work. We want them to work in general. So they're not designed to work specifically with the tariff shock or anything else in particular. They're hopefully designed to work in general. But it's more important than ever that we have good measures to assess underlying inflation because there's more noise.
Yeah. Great. We're going to open up the floor for questions in a bit, but let me just squeeze in one more question here. There's a lot of discussion around AI, technology, the fourth industrial revolution, right? Productivity is very hard to measure also, right? And when it shows up, that's another ball game. How are you thinking about these measures in ways that might help the concept of, the underlying inflation that could potentially help in guiding through, right, this, transition period that we're seeing?
Yeah. So I mean, when I think about AI, it is going to have an impact on the labor market by, anecdotally, it already is, though it's hard to see it in the aggregate data at this point. On productivity, again, it seems it's hard to imagine how it won't have an impact on productivity. When I think about inflation, so productivity, you think of productivity growth, it affects the potential rate of growth in the economy. So it affects the speed limit, the non-inflationary speed limit of the economy, right? With stronger productivity growth, we should be able to have faster GDP growth without inflation picking up. And so that's really important because, when I'm out talking to Canadians, a lot of what I hear is concern about affordability. When you think about affordability, it's a balance between the cost of the things you need to buy and your income. And so, growth is an important part of generating incomes. Now, the other question with AI is how it'll affect the distribution of income, and that's something that, it's beyond the scope of what we're going to get to today. But we are certainly thinking about how AI is going to affect the economy going forward, and how that's going to ultimately feed into our mandate of keeping inflation stable. But at this point, I think like for everyone, it's early days. Yep. It's hard to see it in the data, and so we're sort of gearing up.
Yeah. Another scenario planning right there. Okay, why don't we go around for questions here? We'll be, please. No, there's a microphone coming to you.
So my question is a little bit political. So right now, Canada is facing a trading war from the two biggest economies in the world, from US and China, also the biggest trading partner of Canada. To what extent does it affect the underlying inflations?
Yeah, so a couple of things. So, what you're talking about is the tariffs that have been put on some Canadian exports by the United States and China. And certainly we can already see that is having an impact on the sectors that have been affected. So in the case of the U.S. tariffs, the automotive, steel, aluminum, we can see the impacts in those sectors. We can see job losses in those sectors that are most affected by the tariffs. Now, what that means ultimately for inflation. So this is where a couple of things matter. Number one, we have seen the labor market softening in recent months overall. So we've seen employment decline in the last couple of data points. The unemployment rate rise to 7.1%. More broadly, outside, I mentioned that we're seeing losses in jobs in the sectors affected directly by tariffs. Outside of those sectors, we're also seeing, we're not seeing job losses at this point, but we're seeing slower job growth as hiring intentions are scaled back. So we're clearly seeing some additional slack opening up in the labor market. So that tends to be a downward pressure on inflation. Now, at the same time, though, most of the retaliatory tariffs that Canada had in place, at least on the United States, have been now removed. So that, was something that was going to add some price pressure in Canada, and is now largely gone. So that means less upward pressure on inflation. But then lurking in the background is this bigger issue of, with all these tariffs, so there are the tariffs that China and the US have put on Canada, but then there are all kinds of other tariffs that have been put in place around the world, right? Especially by the US on its various trading partners. And this is going to lead to reconfiguration of global trade. When we talk to businesses, we hear about the fact that, they're either having to find new suppliers, or they're looking for new markets in which to sell their outputs. And that involves costs, right? It's costly to find a new market. It's costly to find a new supplier. And it's unclear to what extent those types of costs, the sort of indirect costs of the trade war, will be ultimately passed on to consumers. And so that's something we're trying to evaluate right now. Are we going to see those indirect costs associated with trade disruptions and reconfiguration of trade feeding through into consumer price inflation?
Thank you very much.
Yes.
Thank you for coming to speak with us today. It was a great conversation. My question I was interested in was, what's one challenge to the Bank of Canada mandate that maybe we aren't seeing in the headlines right now, aside from tariffs or AI or anything along those lines?
I think we have to, I'll go back to one thing that Ramel mentioned at the beginning that I've worked on in the past, and that is we have to be thinking about the overall stance of monetary policy and what that means. And when there's a lot of structural change in the global economy, it can affect what we call the neutral rate of interest, sort of the rate of interest at which we think monetary policy is neither adding or subtracting to pressures on activity and inflation. And so, we're seeing now shifts in global trading relationships. We're seeing shift in demographics. We may be in a world that's more prone to shocks, whether stemming from geopolitical events or from just rapid changes in policy or technology. And so we're going to have to think about what all that means for our assessment of what the natural or neutral rate of interest is. And I think that's something that, I think that there has been some academic and think tank sort of discussion of, but it hasn't really broken through into the broader discussion.
Should we do one quick one and then we'll wrap up? Yes, maybe on the other side, please.
Yeah, so the problems in this presentation are mostly about how to interpret the data that we have and share that information effectively. Are there any possible developments in just having more fine-tuned instruments instead so that you can maybe adapt interest rates more locally rather than having to affect the whole economy?
Yeah, I mean, not really, because, it would be nice if we could tailor policy to specific sectors or regions, because oftentimes the developments in specific sectors or regions can be quite different. The issue is we share one money, we share one currency, and so we can't really have multiple monetary policies while having a single currency. So the answer on that front is no. Now, you mentioned that much of what I talked about was about sort of improving what we can extract from the existing data. I should mention that we're also trying to look at other sources of data. So one other type of data is we've been looking at the micro data underlying the consumer price index. So looking at individual prices and how those evolved. That was really helpful during the post-pandemic inflation surge, where it allowed us to get a sense of the frequency and magnitude of price changes, and allowed us to understand how prices were evolving at a more granular level. I think now with the trade war, it'll also be helpful. It'll allow us to do things like think about, if you have pickles from Canada and pickles from the United States, are the prices evolving differently? And if they are, that maybe tells you something about the tariff impact. So we're certainly also trying to look at a broader set of data.
Well, that's terrific. And that's where, for the regional one, fiscal then needs to come in for the regional one, right? But on that note, let's bring this session to close. Today we've heard, the important work the Bank of Canada is doing, and it is including, understanding the new concept of underlying inflation. Inflation, an issue that affects all of us, right? As well as we've heard about the bank's steadfast commitment to keep inflation on target, right, in this volatile era, thereby fostering conditions for sustainable growth. And we're indeed reassured, by the bank's stewardship in this vital task. So, Deputy Governor Rhys Mendes, on behalf of the Ivey Business School and Western University, thank you for sharing your insights with us, and it was lively too. Go with that.
Thank you for having me. Thank you. It was great.